You're about to dive deep into one of the most consequential global macro events that could reshape markets in 2026. A decision coming out of Japan on February 8th that stands to flip the U.S. stock market on its head. Whether you're a seasoned investor, a finance pro, or someone building wealth for the long term, understanding this isn't optional. It's essential. Imagine global capital flows like ocean currents, subtle, powerful, constantly in motion. And right now, one of the biggest tides is shifting under our feet. Japan isn't just another economy. It's the world's third largest, a massive holder of U.S. Treasuries, and for decades it has been a source of ultra-cheap capital that supported global risk assets, including the U.S. stock market. That all changed in 2025, and now Japan's February 8th decision could be the fulcrum that tips markets into an entirely new regime, one driven by currency dynamics, fiscal policy, bond yields, and investor psychology. Over the last decade, Japanese monetary and fiscal policy acted as a sort of gravitational pull on global markets. The Bank of Japan, BOJ, kept interest rates ultra-low for years, effectively exporting liquidity around the world. Cheap Japanese money fueled the carry trade, where investors borrowed in yen to invest in higher-yielding assets like U.S. equities and bonds. Japanese institutional investors, banks, insurance companies, pension funds became some of the biggest buyers of U.S. Treasuries and American corporate debt. This created a steady backstop of global demand that helped suppress yields and boost asset prices in the U.S. economy. But in late 2025 and early 2026, this gravitational field started to weaken. For the first time in decades, the BOJ pivoted toward a more restrictive monetary policy, raising interest rates to levels not seen in 30 years, reaching 0.75% on short-term benchmarks. That may seem small compared with the Federal Reserve or ECB, but in the context of Japan's decades-long zero-rate era, it's seismic. This has begun to narrow the yield differential between Japanese sovereign bonds and U.S. Treasuries, reducing the incentive for Japanese capital to sit in U.S. markets and pushing investors to reassess global positioning. Now overlay significant political events. The snap election called for February 8th by Prime Minister Sanae Takaichi. Polls show her party commanding strong support and her fiscal agenda, including potential sweeping tax changes and expansionary budget measures, has markets pricing expectations of aggressive fiscal stimulus and continued loose monetary policy. This combination has weakened the Japanese yen to fresh lows, as investors bet that future policy will prioritize growth and liquidity over currency strength. This is where the story intersects with the U.S. stock market, in a high-stakes, cross-border financial domino effect. The yen's weakness, reflected in USD JPY testing levels well above 158, means Japanese investors see lower returns from keeping money in yen-denominated assets relative to abroad. Historically, Japanese institutional capital has shifted overseas when the yen weakens, chasing yields and returns in dollar-based markets. But if yields inside Japan start to look attractive again, thanks to policy, inflation shifts, or fiscal changes, that capital could reverse course back into domestic bonds and equities. Here's why that matters to U.S. stocks. Japanese investors are among the largest foreign holders of U.S. Treasuries and foreign investment in U.S. corporate and government debt. If Japan becomes a better home for capital, even marginally, billions of dollars could be pulled out of U.S. markets and redeployed back into Japan's own financial ecosystem. That would put upward pressure on U.S. yields, raise borrowing costs, and potentially deflate stock valuations that have been supported by cheap global capital. It's not theoretical. This mechanism has already been hinted at by recent market moves. Analysts have highlighted how the narrowing yield spread between Japanese and U.S. bonds is already pressuring traditional carry trade flows, squeezing returns and forcing some risk-adjusted repositioning. In practical terms, this means lower demand for Treasury bonds, upward pressure on yields, and, crucially, outflows from risk assets like U.S. stocks. but that's only part of the equation. We also must acknowledge the speculative psychology driving currency and bond markets right now. The prospect of fiscal expansion under Takaichi's leadership has revived expectations of future government spending, tax cuts, and economic stimulus. That's boosting Japanese equities to record highs and reinforcing the narrative of a new growth era, even amid structural demographic challenges. At the same time, Japanese policymakers are publicly wary of excessive depreciation in the yen, signaling they may intervene to stabilize markets if volatility becomes disruptive. This delicate balance between loose fiscal expectations, monetary tightening, currency risk, and political strategy creates a tipping point scenario. If the yen continues to weaken and Japanese yields remain competitive, capital will flow out of the U.S. and into Japan, pushing up U.S. yields. Higher U.S. yields are historically linked to downward pressure on high growth and tech stock valuations, which are particularly sensitive to discount rates. Put simply, rising yields can derate multiples on expensive growth stocks, flattening what has been a seemingly unstoppable rally. On the flip side, if Japan's policy mix shifts toward a more balanced approach, tightening monetary conditions faster than expected or intervening to stabilize FX, then we could see capital flows reverse again, igniting risk assets globally. That's why even a political event as distant as February 8th in Tokyo is a critical inflection point for Wall Street. The U.S. market doesn't operate in isolation. In today's interconnected financial system, global policy divergence, especially between major players like the U.S. and Japan, sends shockwaves across asset prices, inflation expectations, and investor risk behavior. This decision on February 8th isn't just another economic announcement. It's a trigger event that could reorganize the global capital matrix and alter return profiles across every major asset class. To fully appreciate the significance of this moment, you need to understand the forces at play: capital flows, yield differentials, currency risk, fiscal policy expectations, and investor psychology. These aren't abstract academic concepts. They're the levers that institutional investors, hedge funds, and central banks use to allocate trillions of dollars every day. And on February 8th, one of those levers could move sharply. And when it does, it will ripple all the way from Tokyo to Wall Street. To understand the potential shockwaves for U.S. markets, we need to break down exactly how Japanese policy translates into American stock movements. At the heart of this is the global bond market, the backbone of every financial system. When Japan adjusts yields or fiscal policy, it directly influences the supply-demand dynamics of U.S. Treasuries. For decades, Japanese capital acted like a stabilizer, providing consistent demand for American debt. This helped keep long-term U.S. yields artificially low, indirectly boosting valuations in equities, particularly tech and growth stocks. If February 8th brings a decisive move toward either fiscal expansion or tighter monetary conditions in Japan, U.S. Treasury yields could spike. Why? Because institutional investors, from pension funds to sovereign wealth funds, continuously evaluate risk-adjusted returns. If Japanese bonds suddenly offer comparable yields with lower currency risk, trillions of dollars could flow back to Japan. This outflow would reduce demand for U.S. Treasuries, forcing yields higher. Rising yields increase the discount rate used to value future cash flows, effectively lowering equity valuations across sectors. Consider the historical precedent. In the late 1980s and early 1990s, Japanese policy shifts caused massive global portfolio reallocation, influencing markets from New York to London. While the U.S. economy then had different structural dynamics, the principle remains: capital is fluid, and when Japan changes the game, the world listens. Today, with far greater interconnectedness and leveraged positions, even marginal shifts can trigger outsized reactions. Another crucial factor is the yen-dollar exchange rate. A weaker yen traditionally incentivizes Japanese investors to put more money abroad. However, if the February 8th decision signals stability or a return to yield attractiveness domestically, the yen could strengthen. A stronger yen reduces the incentive to invest overseas, pulling capital out of the U.S. and European markets. For U.S. companies reliant on foreign institutional ownership, particularly in sectors like technology, pharmaceuticals, and consumer discretionary, this could translate into immediate valuation pressure. We also must factor in derivatives and leverage. Hedge funds and investment banks routinely structure trades based on the assumption of continued Japanese participation in foreign markets. A sudden reversal in flows could trigger margin calls, forced liquidations, or rapid rebalancing of global portfolios. These secondary effects magnify the impact far beyond the immediate capital movements. Then there's the behavioral aspect. Market participants are not purely rational. They react to expectations, headlines, and narratives. The February 8 decision is likely to dominate financial media in the days surrounding it, creating a self-fulfilling prophecy effect. If investors anticipate Japanese capital moving out of U.S. markets, some may preemptively sell, accelerating the impact. In trading psychology, expectation can sometimes be as powerful as reality. And in this case, both could converge dramatically. Now let's explore specific scenarios and their implications for U.S. markets. Scenario 1. Japan adopts aggressive fiscal expansion while maintaining moderate yields. This would likely keep the yen weak, encourage foreign investment inflows into Japan, but still maintain a level of liquidity that limits dramatic outflows. In this scenario, U.S. equities might experience short-term volatility, particularly in high-growth sectors, but broad market declines could be contained. Bonds might see yields tick higher but not surge dramatically. Scenario 2 is more extreme. Japan simultaneously tightens monetary policy and signals a long-term domestic bond buying program. Here, Japanese capital could shift rapidly back home, causing meaningful selling pressure on U.S. Treasuries. Yields could spike, forcing equity valuations down sharply, especially for interest rate-sensitive assets like tech, utilities, and real estate. This scenario could trigger a repricing across global markets, with potential spillovers into commodities and emerging markets. Scenario 3 combines political instability with unclear fiscal signaling. Uncertainty around leadership, election outcomes, or debt management could create a risk-off environment, prompting flight-to-safety behaviors. U.S. equities could fall sharply. U.S. Treasuries could initially benefit from a safe haven bid, but eventually face downward pressure if Japanese capital withdraws abruptly. Currency markets would become highly volatile, further influencing multinational companies' earnings and investor sentiment. It's also critical to examine the secondary global effects. When Japanese capital reallocates, it doesn't just affect the U.S. Treasury market. Emerging markets, particularly those with dollar-denominated debt, are highly sensitive to shifts in global liquidity. A sudden pullback of Japanese investment can tighten credit conditions globally, raising borrowing costs and creating cascading effects on corporate earnings, international trade, and investor risk appetite. Additionally, U.S. corporations with substantial operations in Japan could face earnings impacts from currency swings. Exporters may benefit from a weaker yen, while multinational companies earning revenue in yen could see translation losses if the currency strengthens unexpectedly. Portfolio managers will need to account for these factors in real time, further amplifying market reactions. Finally, consider the timing. February 8th is not just a date. It represents a convergence of fiscal policy signals, central bank guidance, election outcomes, and market positioning. Investors have been positioning ahead of the event, adjusting portfolios to hedge potential risks. When the decision is announced, we may see a liquidity vacuum, where rapid, simultaneous trades exacerbate volatility. This is exactly why some of the most powerful market moves occur around scheduled policy announcements. Liquidity is thin, expectations are high, and human behavior adds momentum. Understanding this interplay between policy, currency, capital flows, and investor psychology is key to anticipating the February 8 impact. It's a complex, interconnected system where small decisions in Tokyo can translate into significant movements in New York. Whether you're managing a retirement portfolio, hedge fund, or simply building wealth, being aware of these dynamics can make the difference between navigating market turbulence successfully or being caught off guard. February 8th could be remembered as a turning point, a day when Japanese policy reshaped the global investment landscape. Markets may not react immediately or predictably, but the forces set in motion could influence trading patterns for weeks, months, or even longer. For investors, this means heightened vigilance, strategic positioning, and a clear understanding of risk management principles. So what should investors do in the lead up to February 8? First and foremost, understand your exposure. If you hold U.S. equities, particularly growth-heavy sectors, recognize how sensitive your portfolio could be to rising yields. Stocks in technology, communications, and consumer discretionary are most vulnerable because their valuations depend heavily on discounted future cash flows. Even modest shifts in interest rates can meaningfully alter their price trajectories. Second, monitor currency movements closely. The USD-JPY pair is more than just a number. It's a gauge of capital flows and investor sentiment. A sudden yen appreciation could indicate that Japanese investors are reallocating funds back home, while continued yen weakness could suggest persistent outflows and continued support for U.S. markets. For multinational corporations and exporters, these swings have direct revenue and margin implications. Third, consider bond market positioning. U.S. Treasuries, particularly long-duration instruments, are sensitive to global capital flows. If Japanese capital withdraws en masse, yields could spike sharply, causing immediate losses for bondholders. Investors with a substantial allocation to bonds should assess duration risk, hedge if necessary, and prepare for potential volatility around the event. Fourth, diversification is key. The February 8 event underscores the importance of not concentrating risk in a single market or asset class. Global interconnections mean that shocks in Japan can ripple across equities, bonds, commodities, and currencies simultaneously. Diversification across geographies, sectors, and asset types can help mitigate the potential downside of a sudden capital reallocation. Fifth, pay attention to market sentiment and news flow. Unlike many economic events, this one combines political outcomes, monetary policy shifts, and market psychology. Short-term movements may be exaggerated as traders react to headlines, creating opportunities for nimble investors. Watching liquidity, volume, and market reactions in real time can offer actionable insights and signal when to enter or exit positions. Finally, think long-term perspective. While February 8th may trigger immediate volatility, it also represents an opportunity to understand broader structural changes in global capital allocation. Japanese demographics, fiscal pressures, and monetary policy are reshaping the way capital moves internationally. Investors who grasp these trends now are better positioned for future market cycles, whether in equities, bonds, or alternative assets. For professional wealth management and portfolio strategy, this means stress testing your allocations. Scenario analysis should include a sudden yen appreciation, aggressive U.S. yield response, and simultaneous global liquidity shifts. By preparing for multiple outcomes, investors can act decisively rather than react emotionally, turning potential volatility into opportunity. Moreover, consider the role of hedging instruments. Currency futures, options, and interest rate derivatives can provide protective exposure against abrupt market swings. Experienced investors may also explore pairs trading strategies or use safe haven allocations, such as gold or short-duration government bonds, to buffer portfolio risk. It's also essential to recognize that not all sectors will be equally affected. Defensive sectors such as utilities, consumer staples, and healthcare may offer relative stability during periods of rising yields and capital outflows. In contrast, high-growth sectors, especially those with leveraged balance sheets or global revenue exposure, may experience amplified volatility. Strategic overweighting or underweighting based on risk tolerance can optimize returns while mitigating exposure. Beyond market mechanics, the February 8 decision highlights a critical lesson for investors. Global events matter, even when they feel distant. Japan's policies, currency movements, and political outcomes may be thousands of miles away, but in today's interconnected world, their impact can arrive within minutes. Staying informed, monitoring macroeconomic indicators, and understanding cross-border capital flows are no longer optional. They are essential for professional-grade portfolio management. For those seeking growth, this may also be a rare opportunity to reposition. Volatility often creates mispricing, and careful analysis can reveal undervalued assets temporarily pressured by capital outflows or investor panic. Contrarian investors and long-term wealth builders can identify entry points during such periods, provided they remain disciplined and informed. Finally, remember that markets are driven by both data and perception. February 8th is not just a date on a calendar. It is a convergence of policy signals, investor psychology, and structural shifts. Being proactive, prepared, and educated allows investors to navigate uncertainty with confidence rather than fear. In conclusion, Japan's February 8th decision could indeed flip the U.S. stock market, but it also provides a blueprint for how global interconnections operate in practice. Investors who understand the mechanisms, capital flows, yield spreads, currency dynamics, and investor sentiment can position themselves to both protect their wealth and capitalize on opportunities. By combining careful analysis, diversification, hedging, and situational awareness, individuals and institutions alike can approach this pivotal moment strategically. The key takeaway is simple: distance does not diminish impact. Policy decisions in Tokyo can influence asset prices in New York. Being aware, prepared, and strategically aligned is what separates reactive investors from those who thrive in an interconnected financial world. February 8th is more than a date. It is a reminder that global markets operate as a single dynamic ecosystem, and understanding the levers of influence is essential for building and preserving wealth.